The market is getting ready to take in Wednesday's Fed decision. No major policy changes are expected given the deluge of Fed activity in response to the coronavirus, and it will likely be more about the tone of the Fed's message. We anticipate the Fed will remind the market that it is committed to doing whatever it takes to keep the economy running along while projecting optimism with respect to the outlook going forward. At the same time, we have seen quite a bit of optimism in the lead up to the decision as governments around the globe talk about reducing lockdown restrictions and getting back to normal, and so we're not convinced the Fed will be able to offer a message as upbeat as sentiment has been ahead of this decision. As a reminder, since the beginning of March, the Fed has taken vigorous action in response to the pandemic fallout, dropping rates back down to a record low, eliminating reserve requirements for banks that hold money at the Fed, creating swap lines with other central banks around the world, instituting an unprecedented, unlimited bond buying program, and initiating a $2.3 billion loan provision for businesses and local governments. All of this has helped to stabilize the market, though there is a serious concern that the cost has been extremely severe, with the Fed rising to an all-time high as a consequence. The Fed balance sheet, that is, up to a whopping $6.6 trillion, easily surpassing the $4.5 trillion balance sheet from the financial markets crisis of 2008. All of this comes at a time when something that had been a comfort to the Fed for many years is no longer a comfort, with the virus hitting the labor market hard. 26 million Americans out of jobs over the past 8 weeks, and this number still expected to rise some more. The rising unemployment rate will challenge the Fed's mandate and could expose the vulnerabilities of the Fed's massive balance sheet a little bit more. Lucky for the Fed, it hasn't needed to worry about rising inflation, for if this risk comes creeping in, things could get real ugly real fast. In such a scenario, the Fed would be forced into thinking about needing to tighten policy to offset the rise in inflation, though, again, the Fed is at least not needing to be worrying about this at this point in time. As far as the Fed's assessment of recent economic data goes, we believe the central bank will downplay the distressing readings as more of a one-off event resulting from the pandemic, with data expected to rebound in the months ahead. How the Fed communicates its message about the outlook going forward will be what is most important to the market. And while we do see the Fed delivering a cautiously optimistic communication, we're not convinced it will be enough to provide additional momentum to the run-up in risk markets that we've already seen. Central bank policy that offers up a solution of unlimited support is definitely concerning in our view, and even without the coronavirus, we've warned of just how exhausted the state of monetary policy accommodation has been. While it's possible the market will continue to buy into the Fed's assurances, we can't help but be a little more concerned about the Fed's ability to respond to that next future negative shock to the global economy when it comes rolling in. That's all for now.